20 warning signs that can trigger a tax audit according to former IRS officials. An IRS audit is a review or examination of a taxpayer's account and financial information to ensure information is reported correctly according to the tax laws and to verify the reported amount of tax is correct. In this program, we're revealing 20 warning signs that can trigger a tax audit based on interviews with former IRS officials, as well as our own research and the latest tax industry news. Audits aren't terribly common. On average, 1%, nearly 1.5 million of individual returns are examined every year. According to the agency, selection for an audit does not always suggest there is a problem. The IRS uses several different methods, typically categorized into two main clusters: random selection and computer screening. Sometimes returns are selected based solely on a statistical formula. The agency compares a person's tax return against norms for similar returns. The agency develops these norms from audits of a statistically valid random sample of returns as part of the national research program the IRS conducts. The IRS uses this program to update return selection information. Number 2, related examinations. The agency selects a taxpayer's return when they involve issues or transactions with other taxpayers, such as business partners or investors, whose returns were selected for audit. Next, an experienced auditor reviews the return. He or she may accept it, or if the auditor notes something questionable, he or she will identify the items noted and forward the return for assignments to an examining group. The bottom line: filing your return completely, accurately, and honestly can reduce your chances of being pinpointed and increase the odds of a favorable outcome. Watch now for 20 potential audit triggers. Welcome back, folks, to another edition of Sweetie Kiwi. I'm doing marvelous, especially when it comes to taxes. I love paying taxes, and I think everybody should. How you doing? I hope you're doing fantastic. I'm doing marvelous, and if you are doing as marvelous as I am, go grab a cup of coffee or tea or vodka. Let's roll. I want to quickly give a shout out to Amber Shaw in Pleasant Hill, Texas, Harley Austin in Romulos Science, that's in Texas, and Lauren McDonald in Buenos, Texas. We really appreciate your help here. Thank you for suggesting this topic. We really appreciated that, and we want to thank our millions of viewers and listeners throughout the world. Thanks for your support. We really appreciate it. Now, so today we have 20 warning signs that can trigger a tax audit according to former IRS officials. Number 1, if you earn more than $200,000, if you are basically part of the 10% of American earners, there is a chance that you might be audited. All right. Now, the thing here is that, think about it, when it comes to auditing, the IRS has to make a business decision, right? Why would auditors go after people who make less money? Because the odds of collecting more taxes increase when you go after folks who are making more money. So it's just a pure business decision. Of course, the IRS will never acknowledge that, but it makes sense from a business standpoint, right? So if you earn more than $200,000, you could be audited. Number 2, you earn no income or too little income to justify your lifestyle. Let's say you are basically living in a very posh zip code, right? And the IRS identifies based on your Social Security, based on your address, that you're living in a place where mortgages go for $10,000 a month, and you're declaring no income to the IRS, or you're declaring very little income. This could be a red flag. Number 3, you make too many charitable contributions. Folks, this is very important. Now, if you donate clothing, furniture, and cash to charitable organizations throughout the year, please keep receipt, right? Because the thing is that those donations can trigger an IRS audit. Why? Because the thing is, the IRS might get suspicious that those donations aren't real. If you want to avoid the audit trouble, make sure, again, like I said before, that you keep receipts from the organizations to which you donate. Now remember though, that when it comes to non-cash donations of up to $250, you'll need a receipt from the charity. The receipt should list the date and location of your donation, along with the name of the charity and a brief description of what you donated. For non-cash donations of more than $250, again, you will need a receipt, but this receipt must also state whether you received any services or goods from the charity in return for your donation. That's the second category. The third category, for cash donations of less than $250, you can use a receipt showing when you made your contribution and how much it was to prove your donation to the IRS, right? The thing is, if you don't have the receipt, as long as you can show some kind of a bank statement, a canceled check, or credit card record proving your donation, that's perfect. The same applies for a cash contribution of more than $250. But remember, for those large donations, you need a written receipt from the charity. So, number four, warning sign that can trigger a tax audit. Your ratio of gross income to adjusted gross income doesn't make sense, right? Basically, they call it AGI and GI. If you make a lot of money, the IRS obviously wants they want to make sure you're paying your fair share of taxes, right? Now, the thing is, let's just say that you are making, say, 200 grand gross income, but you have a low adjusted gross income. So for those who are not familiar, the adjusted gross income is the gross income minus all the deductions, right? The itemized deductions. So if you have the gross income of 200 grand and your adjusted gross income is, say, 25 grand, you telling the IRS that you have deducted $175,000 in deductions, in itemized deduction. That's a lot, right? So basically what's happening here is that the IRS is thinking, oh, this person has, there is a huge disparity and some of those deductions are not legit. So they'll come after you. All right? I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're still continuing our conversation around the audit sign that can trigger a tax audit from 2020 forward. If you just joined us and you like the conversation we're having so far, or if you haven't done so already, please subscribe to our channel and turn on the notification bell. We want you to also please comment below, give us your experience with dealing with the IRS. Share, like. Everybody needs to know this, whether it is tax season or non-tax season, right? We need to know this. Now, quick shout out to Faith Harrison in Pinson, Tennessee, Isaac Morgan in Jonesboro, Tennessee, and Abigail Bell in Fayetteville, Tennessee. Thank you so much for your support. We really appreciate it. We thank you so much. Now, number 5, if you don't report all your earnings, you might be a candidate for a tax review, a tax audit, right? Let's say you fail to report taxable income. So the IRS is receiving, they're looking at their own copies of 1099 and W-2 incomes forms that, and they just comparing that to the one you sent them, and they're realizing that you're actually missing out on some kind of income. They will come after you. Number 6, you claim too many deductions, right? Remember earlier I was talking about the gap between your gross income and adjusted gross income. This warning sign is correlated to the other one, right? So if you're claiming too many deductions, this could be a red flags. This could raise red flags with the IRS, right? So I'm talking about things like, if you're claiming your home office, you're claiming business expenses, you are claiming things, you're claiming things that are too much when it comes to equipment purchases, travel expenses, meals, hotel stays related to your business. The IRS might think this is not legit and they'll come after you. Another thing that's very important is that if you run your own business, you can save a lot of money on taxes, but make sure if you operate this business out of your house, you can deduct a portion of your utility payments and other stuff, but make sure that you keep all the receipts and you can prove them to the IRS. Because historically, the agency has gone very strong after people who are claiming illegitimate expenses when operating from home. All right? Which leads me to number 7. If you claim a home office deduction, this is a red flag with the IRS. Why? Because those deductions historically have been rife with fraud. Because a lot of people, because the agency understands that it could be very tempting to give oneself undeserved deductions for expenses that don't technically qualify, right? Now, when it comes to taxes, the IRS defines the home office deduction as reserved for people who use part of their home exclusively and regularly for their trade or business. Let me repeat that. To qualify for the home office deduction, you've got to use part of your home exclusively and regularly for your trade or business. All right? So, if you use the home office for work and work only, then yes, this will qualify, right? So, before you try to deduct the purchase of a 100-inch flat screen TV out of your, on your taxes, think twice. All right? Number 8, you use round numbers. If you use round, nice, neat numbers, chances are the IRS is coming after you, because the IRS understand that, life is not just like expenses don't come just as in round numbers, right? So it's not just if you use 1 or 2, that's fine. But if there is a pervasiveness of round numbers throughout your 1040, yes, this could be a trigger for an audit. All right, I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're still continuing our conversation around the 20 warning signs that can trigger a tax audit. And I want to quickly acknowledge the loyalty of some of our beautiful listeners and viewers, particularly Kate Turner in Siston, South Dakota, Evan Thomas in Ipswich, South Dakota, and Sophia Butler in Millbank, South Dakota. All right, number 9. You claim a large number of charitable contributions, right? If you are claiming contributions in cash or non-cash, this could be a red flag, because the IRS looks at your income, looks at folks who are in your age bracket, in your salary bracket, and they think about how much those folks are giving, and they compare that with you and see if it makes sense. If you are giving too much money, your tax, your returns will be flagged, and you will be audited. Number 10, you blur the lines on business expenses, right? This is kind of a little close to what I said earlier about the home office, but this is more general. So if you claim business tax deductions excessively, the agency will take a close look, right? So let's just say that you are basically you are operating from home and you want to basically deduct, for instance, your take-home vehicle or your home vehicle, right? And the agency wants to make sure that you're using the vehicle exclusively and only for work, right? Because this is, again, the definition of the agency. If you want to deduct, because the IRS allows you to deduct everything from repairs to depreciation to gas, everything on your tax returns, right? But the agency wants to make sure, yes, you're using the vehicle, you're using the automobile exclusively and only for your work. So they'll come after you if you blur the lines on business expenses. Number 11, you claim you work in real estate, right? Now, real estate is it's a very picky topic when it comes to the IRS, because they basically can, they can come after you because they are thinking that you make a lot of money. But so if you're saying you work in real estate, but your income is not showing, then they know there might be a discrepancy. Now, another thing that's important, I want to generalize, I want to broaden the scope of this particular number here, is that there are certain industries where historically the IRS knows people are making money. So if you, for instance, you are an investment banker working in Wall Street in New York, and you just say, I just made the 25 grand, they know this is not normal, especially if you are, even an entry level banker doesn't make 25 grand a year. So they kind of look at your occupation and the income and think about the gap. And they've got tables, they have salary tables, pay tables on, by industry. All right. Number 12, you make typos or a math error. Now, the thing is that if you make an honest mistake, that's fine. But if something looks fishy, you bet they'll come after you, especially if something like if you have an incorrect social security number or you have calculations that don't add up. This could bring an additional scrutiny from the IRS. Now, the thing is that, lately it has become a lot easier, right? If you use tax software to file your returns, chances are you're not going to make those mistakes. You can only make those mistakes if you manually prepare your returns, right? And you file your returns manually. You can even use software to file the taxes and then print out the returns and mail it, if that's what you want, to the IRS, right? So try to ditch the typos or math errors on your return. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We want to acknowledge Johanna Fisher in Clover, South Carolina, Diego Bates in Columbia, South Carolina, and Gabriela Bender in Fairfax, South Carolina. Science number 13: you deduct 100% of a car for business use, right? This goes back to the vehicle deduction again that I talked about earlier. But if the deduction is legit, make sure you maintain a proper paper trail, right? Because they will come after you and they'll ask for explanation. Number 14, you claim losses from a hobby, right? Now, the thing here is that, the IRS will expect your business to turn a profit, in, let's say, the last 3 to 5 years. Let's say you start a business. The agency is pretty much patient because they know the first few years might be rough. But if you keep making losses over and over and over and over, then they realize that they will come after you to dig a little deeper to know what's really going on. So the thing here is that if you don't make money after 3 years or 5 years, the IRS at that point will consider your business a hobby. So from that point on, you can say goodbye to claiming losses from it on your taxes. All right. So the thing here is that, remember, the IRS thinks that if you get into business, you have a solid plan, right? And if you don't, either you just stop your activities or you go bankrupt. But if you stay in business for 10 years and every year you claim losses, that's a red flag. That's a big no-no. All right. Number 15, you are self-employed. Business owners are known to attract additional scrutiny from the IRS, right? They would take a closer look at the returns of self-employed people. They will basically, because they know that, usually the returns are not prepared by actual companies. So if you claim self-employment income and deduction through your individual income tax returns, what you want to do is you want to double, triple, quadruple check your figures, right? And make sure that you are able to back up your deductions, because they will ask for some explanation for sure. Number 16, you break the rules on foreign accounts. Now, there's something called FATCA, Foreign Account Tax Compliance Act, that has very strict reporting requirements for foreign bank accounts. So the thing here is that, this law kind of requires banks to identify American customers or American asset holders and provide that information directly to the IRS. So, if you have accounts overseas, you must report this on a new form called 8938. That's Form 8938, right? Now, the thing here is that make sure that not only the accounts you have, you are reporting them, but make sure any capital gains, if you have brokerage account, any capital gains are also recorded and reported, and maintain a pristine paper trail to back up any deductions. All right, I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're still here, continuing our conversation. Please, if you like the content of today's show, consider subscribing to our channel. Turn on the notification bell so you are aware of new shows. Comment below, share, like. We all need to have that info. I want to acknowledge some of our most loyal fans and listeners and viewers. I have Samia King in Providence, Hendrix Wheeler in Harmony, Adelina Skinner in Warwick. Thank you so much. And all of those cities are in Rhode Island. Samia, Hendrix, and Adelina in Rhode Island, thank you so much. Number 17, you claim the Earned Income Tax Credit. Now, you have to understand the EITC, the Earned Income Tax Credit, is intended for those with low to moderate income, right? So the agency wants to make sure that any tax refund goes to a qualified taxpayer, right? And not someone who's just out there scamming the system, right? So just make sure that you need to have dependents that you can claim. And the thing here is that the IRS makes sure that nobody else but you has claimed the same dependents. Number 18, something doesn't add up. Let's say, for instance, you are, and this is more, I would say, judgmental. And it takes years of experience as a tax auditor to find those things, to basically spot those inconsistencies, right? Let's say you're claiming large deductions on a small salary, for instance, right? Or you have expenses that are proportionally unusual compared with income on your tax returns, right? So those are things that could really promote some kind of scrutiny. Number 19. You have 3 consecutive years of business losses. Now, I spoke earlier about having, the IRS changing your business structure into a hobby. Now, before I was talking more in general in terms of how the agency will just kind of look at other companies in the industry also. But here, this decision is just more dramatic, more drastic, if you will. If you claim 3 consecutive years of business losses, those usually are reported on a Schedule C. The IRS might think that you are artificially deflating, you are artificially decreasing your income from other sources so you don't have to pay taxes, right? So you want to make sure that you are basically, again, backing up everything, every loss, and making sure those are accurate, the losses are accurate. Number 20, and that's the last one here, you don't report cryptocurrency. Now, cryptocurrency has revolutionized the investment world in the last 5 years, and it is going to be an emerging issue with the IRS. The reason being that people buy something with cryptocurrency and they don't know, or they don't think that this is a taxable transaction. It is. If you receive Bitcoin, for instance, as income, or you have successfully mined, that Bitcoin, these transactions may need to be reported. Now, the thing here is that make sure that you don't, if you're not familiar with the tax issues, just hire an expert, right? You can hire a CPA, a certified public accountant, or an EA, an enrolled agent with the IRS, and those experts will be able to help you. Remember that the IRS receives information from Coinbase, which is a digital currency wallet. And the thing here is that if the IRS receives the info from Coinbase and they realize that there is a discrepancy between what they received from Coinbase and what you are sending them, they'll come after you. All right? I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're about to wrap up today's conversation, and I want to give a shout out again to great and loyal fans and listeners. I have Leilani Henson in North Wales, Pennsylvania, Caleb Sanchez in Duckenham, Pennsylvania, and Brooke Vance in Vico, Pennsylvania. So I want to quickly wrap up and give you a recap of the 20 warning signs that can trigger a tax audit. You earn more than $200,000. You earn no income or too little income to justify your lifestyle. You make too many charitable contributions. Your ratio of gross income to adjusted gross income doesn't make sense. You don't report all your earnings. Number 5. Number 6, you claim too many deductions. You claim a home office deduction. You use round numbers. You claim a large number of charitable contributions. You blur the lines on business expenses. Number 11, you claim you work in real estate. You make typos or a math error. You deduct 100% of a car for business use. You claim losses from a hobby. You are self-employed. Number 16, you break the rules on foreign accounts. You claim the earned income tax credits. Something doesn't just add up. You have 3 consecutive years of business losses, and you don't report cryptocurrencies. Now, here is today's call to action. We like to give our viewers and listeners a call to action at the end of every show, and today's call to action relates to steps you can take and tips you can implement today to make sure you are never audited, regardless of how much you're making, regardless of it doesn't matter. So be exact, clear, and neat. You want to understand the selection process, right? The review process. You want to find out whether you elect the target. Never leave anything blank on a tax return. If you are self-employed, properly indicate so. You can include explanations. A lot of folks think that basically you only file a tax return and put the numbers. No. If you have some explanations to provide, put things on a piece of paper and attach it to the returns. The auditor will read those explanations, right? Remember what is often questioned. You want to avoid filing amendments to your return, right? It's always better. Unless you are forced to, don't file an extension. You want to check your math, and you want to comply with the filing timeline. All right? Thank you very much for your attention, and I will see you next time. And until then, stay marvelous.